Hi, good morning, everyone. I'm Charlene Young, and I'm a Senior Technical Consultant here at AJ Bell. Welcome to today's webinar, Investing for Children. Mindful of the fact that we are yet again in lockdown, and many of you and your clients are probably faced with the task of trying to work from home and also undertake homeschooling. So I'm guessing your own investment in the present will be one of time in that, but hopefully the next 45 minutes or so will prove to be time well spent too. So a little bit of housekeeping before we start today. Please feel free to ask any questions as we go along at any time. To do that, you can use the question box within the control panel on the right-hand side. These questions will be seen and answered via email by myself and the team after today's webinar. Again, if there's any technical problems as we go along, please pop those in the question box too. An email will be sent out about an hour after the webinar today asking you guys to fill out a feedback form. On the back of that, you'll get a CPD certificate and a copy of the session slides issued to you as well. Just a quick reminder, this webinar and its content is for a professional advisor audience only. Okay, so today, when grandparents or parents do want to make a gift to a minor child, perhaps in advance of when the money might be needed. Often we see bank accounts might be set up to hold cash gifts with parents acting as a nominee or a signatory. But generally, when we're talking about investments, children cannot hold unit trusts, investment funds or investment bonds directly because they're under 18 and not able to legally contract. So the main focus of today's session is talking about investing for children and grandchildren who are under 18. We'll look at what happens to accounts and wrappers designed for children, as well as trusts. And we will also briefly look at what happens to those pots when a child reaches 18. But as I say, the focus of today is really starting investments and investment accounts for those children and grandchildren under 18. So first section, gifts. So today we're talking about investing for children, but where will the funds to be used when we invest for children or grandchildren actually come from? In almost all of today's examples, there will be a gift of some kind. This, of course, could mean that the type of gift, from whom it is gifted, and what is gifted from, so capital or income, will have different tax implications too. Okay. There are some outright gifts that can be made that will be completely exempt from an inheritance tax point of view. I won't list them all here just for time today, but the main ones we're thinking about here, just to get your brains whirring, are the individual annual exemptions we all have of £3,000 per annum, specific gifts that can be made upon marriage by parents and grandparents, and gifts from surplus income that do not affect normal expenditure. As we go along, as I mentioned, we will have a brief look at tax and the implications of tax status of each gift at kind of a high level as we go through today. Okay, so when we're going to look at accounts designed specifically for children, I thought it's best to start with some of these tax wrappers that actually have junior in the name. So our first account, the junior ISA. So as we're talking about investing today, rather than sort of savings in cash necessarily, we're going to concentrate on stocks and shares, ISAs and junior ISAs. So some key facts about who can apply for a junior ISA, who it can be open for, and actually who can do that application. So in terms of the child themselves, they must be under 18 to be eligible for junior ISA. They must also be a UK resident, although the extra rules surrounding non-UK resident Crown employees and dependents of those Crown employees also apply as they do for adult ISAs. The child cannot hold a child trust fund. However, if they do, there is the option to transfer this immediately as part of the application, and they will still be eligible for a junior ISA. If there's no plans to transfer that child trust fund, then the junior ISA application will not be valid. The main distinction here between sort of adult ISAs and junior ISAs, apart from the obvious age one, is that a child can only hold one junior ISA of each type. So one cash junior ISA and one stocks and shares junior ISA. With adult ISAs, as we know, you could actually go to a different provider each year to use your annual subscription, and you can have these pots elsewhere. With junior ISAs, it really is the child can only hold one of each type. It is possible to transfer freely between providers and between cash and stocks and shares if you do hold one of each of those. Okay, the crucial point here with junior ISAs in terms of the application is it's only the parent or the legal guardian that can actually make the application. This person is referred to, as you may know, as the registered contact. The registered contact themselves must be age 16 or over at the point of making the application, and that actually applies even for stocks and shares junior ISAs. Normally with adult ones, you would have to be 18 to obviously hold that. One question that we do get quite a lot is from clients who are grandparents and they want to open a junior ISA for their grandchild. Unfortunately, unless they are the ones with parental responsibility, that is not possible. It's worth bearing in mind it's not an account that a grandparent can open, and actually once it's up and running, even if the parents opened it, if the grandparent wanted to be sort of actively involved with the investment choices and this managing the account, that's not possible. That has to be done by the registered contact with the advice of yourselves, obviously. Okay, so in terms of junior ISAs and subscriptions, the limit now is actually £9,000 per year. So it actually more than doubled quite recently. So although the junior ISA must be established and managed by the registered contact, the parent or the guardian, anyone can make a subscription to it for the benefit of the child. So this is where grandparents can come in. As I mentioned, the annual subscription limit is currently £9,000 for the current tax year. So this actually allows a pot of investments and savings which are free from income tax and capital gains to be accumulated for that child or grandchild. And if you're starting quite young, you can see how that £9,000 with the benefit of investment growth can quite quickly build up. Quick word on how the subscriptions are treated. So all subscriptions are treated as gifts for inheritance tax purposes. Here, something called the parental settlement rules, they do not apply to the money that is subscribed for the child and the gift that is made. We will cover these rules in a little bit more detail when we look at trusts, but that's an important feature of the junior ISA accounts. The parental settlement rules do not apply to any subscriptions made by parents. If the annual subscription is paid each year from surplus income, the gifts may be exempt and immediately outside of the donor's estate for inheritance tax as well. So again, that could be an important one for grandparents as well as parents as well. So if you're keeping good records of income levels, if it can be proved that the subscription, however small, however large up to the limit is made, if it does not affect normal expenditure and it comes from surplus income, then it's completely exempt from inheritance tax. Quick word on overseas. So obviously once the account or when the account is applied for, the child must be UK resident or a Crown employee overseas or a dependent of one. Once the account is up and running, subscriptions can continue for a child who ceases to meet the UK residency criteria as long as that child was eligible when the JISA is open. Okay. I've got a note there saying the subscriber can be resident overseas as well. Obviously, please check with your provider as to their requirements from an anti-money laundering point of view, but there's nothing in the rules to say that the subscriber, from a tax point of view, cannot be resident overseas. Okay, so just moving from our junior ISA subscription slide, just wanted to have a quick word about child trust funds. There's a bit of information on the slide here. I won't dwell on it for too long, as child trust funds are no longer available to set up, but inevitably you will probably have some clients who have children or grandchildren at least who were eligible for trust funds, child trust funds, have a child trust fund. And the main reason I wanted to highlight them is because the subscription years actually run in birth years for child trust funds rather than tax years for junior ISAs. As we mentioned before, they can be transferred to the JISA or the junior ISA when opening that new junior ISA, as long as that's done at the start of that junior ISA applications. And another thing that might come to light is that the first child trust funds actually started to mature in September last year. So as those very first children who got the first vouchers back in 2002 turn 18, they will gain access to their child trust funds. The main kind of point that I wanted to build on from the fact that subscriptions run in birth years is that for the few clients that you might encounter where child trust funds are relevant, there is a unique kind of planning opportunity that can be used in conjunction with junior ISAs and transfers. So we'll move on to that next in the next slide. Okay, so the aim of this slide, it will get a little busier as we go along, is to show how up to £27,000 can be paid into a child savings account over a calendar year. As I mentioned before, this is because the subscription period for a child trust fund runs on a birth year, and for junior ISA it runs on a tax year. So let's imagine we have a child trust fund and the child's birthday is the 1st of August. Okay. So if we wind forward to the 1st of June 2020, so at the start of that tax year but before the child's birthday on the 1st of August, a subscription to the child trust fund of £9,000 is paid. That's already in the account. Okay, on the 1st of August, the child has another birthday. And as we're in a new subscription year for the child trust fund, albeit we are in the same tax year, another subscription can be paid in. And we'll assume that's on the 1st of February 2021. The next day, suppose the parent now opens a junior ISA. Now, as we know, those subscription years run in tax years, and in order to make a successful application, any child trust funds must be transferred as part of that junior ISA application. So once that is done and dusted, but before the end of the current tax year, the parents or grandparents are then able to subscribe another £9,000 as a new JISA subscription. A total of £27,000 saved in what is less than 12 months. So it's a little bit niche. Obviously, it involves the child having a child trust fund and then opening a junior ISA and making a transfer there. But again, if you've got parents and grandparents looking to make use of some surplus income or capital, it's a nice transfer opportunity to be aware. Okay, back to a focus on our junior ISA account. We've actually got another planning opportunity to go through with children who have got junior ISAs and might not have child trust funds, and they're turning 16, sorry, so our old teens. So 16 and 17-year-olds can actually have an adult cash ISA and also continue their stocks and shares junior ISA. So there is an opportunity here for £9,000 to be used as the junior ISA subscription, and then another £20,000 to go into a cash ISA. There, of course, will be gift implications of receiving the cash from a relative, and we're looking at slightly higher levels now of £29,000. But again, it's worth pointing out. So if we're concentrating really on investments today rather than cash, we can look at an example involving a stocks and shares ISA when a child turns 18 and how that can interact with their existing stocks and shares junior ISA. So if we look at this example of Rufus, he will turn 18 on the 10th of February this year. He currently holds a junior ISA, stocks and shares junior ISA. So a subscription of £9,000 is paid to his junior ISA before his birthday in the current tax year. As soon as he turns 18, the junior ISA converts to his very own adult stocks and shares ISA on the 10th of February. And once that's up and running, he's in the adult stocks and shares ISA regime, and that stocks and shares ISA can accept a subscription of up to £20,000 on or before the 5th of April, so the end of the tax year. So again, a kind of handy planning point for those older teens. Okay, our final slide now on junior ISA. What happens when the child turns 18? Okay, so generally, in terms of access to junior ISAs, withdrawals cannot be made from the account. The only exception there is if the child is unfortunately terminally ill and the registered contact liaises with HMRC in that respect. So ordinarily, when the child reaches 18, the account is converted to an adult ISA, so that middle arrow there, and then withdrawals can be made from that account. I guess the new adult investor can choose to keep the ISA, withdraw all of the funds, some of the funds, or actually even make a partial transfer to a lifetime ISA in order to benefit from the bonus there. So if one of the objectives for the funds when gifts were being made to fund the junior ISA was to get on the property ladder, for instance, obviously there's the lifetime ISA there to make use of and make use of that bonus that's available each tax year on payments made into that lifetime ISA. The third option obviously is that they could take all or some of the money. Some people, some advisors, some direct clients are worried about the potential to access a large pot of money at 18. Obviously, if the maximum subscriptions had been made, there is no doubt that there could be a substantial fund available at age 18. However, as the account has been set up and managed by the person with parental responsibility alongside an advisor, there is the opportunity to involve the child in the planning and investment process long before they can actually access the capital, making it more likely that they're engaged with the funds and really aware of what the wishes were of those making the gift to the account on their behalf were. Obviously, they're under no obligation to then go and use it to buy a house, use it for university fees, but or even a car, or to get on the property ladder, as you said. But the likelihood that an engaged investor, even a child who's aware of this account and is perhaps engaged with the investment decisions that are being made and the plans for the funds, will benefit from this engagement and hopefully continue to be an investor of some kind sort of through their adult life. Okay, so that's it for junior ISAs. The second specific wrapper I wanted to cover is the junior SIPP. Okay, so a few key facts about junior SIPPs. So the SIPP is opened for the child who is under 18, and they must be a UK resident as per our kind of junior ISA rules there. So contributions can be made into the child or grandchild's pension, usually up to 3,600 gross, so that's our 2,880 net, and they're classed as what we call third-party pension contributions. If we're talking about older teens here, who may have a Saturday job, might have some kind of income, earned income it would have to be, the contribution limit would actually be up to 100% of their relevant earnings, as it would be with adult clients, but usually we find that the basic amount there of 3,600 gross applies. If they did have their own income, they're unlikely to be in a position to kind of save this, and it probably isn't appropriate given some of the access issues with junior SIPPs that we'll talk about in a second. So we do find that sort of parents and grandparents would make contributions as a gift, either from their own separate income or from capital. Again, the gift could be exempt. So it could be exempt because the net gift would be under £3,000 if someone hasn't used that annual exemption for IHT. It could be exempt if it's made from surplus income without affecting normal expenditure. So there are some opportunities there. Although it is classed as a gift, there are some opportunities to ensure that it is exempt and outside of the estate for inheritance tax purposes. And the account itself will convert to a SIPP at age 18. Of course, the main downside with junior SIPPs is that the child cannot access the money until they reach the normal minimum retirement age. Currently 55, but as we know, it is on the rise and it's now legislated to increase. For children today, it isn't far-fetched to consider that it probably will be 60 or even more by the time they're looking to access their retirement funds. 60 would certainly make it in line with the lifetime ISA for retirement. So that is obviously one concern that people do have with using this account. Okay. One thing I did want to mention, it's certainly not what we call like a lifetime planning opportunity, but with the introduction of the new flexible death benefit rules with pension freedoms, it can be beneficial for clients over 75 to consider passing unused pension or any unused pension they may have to their grandchildren by making a nomination. So the scheme administrator or trustees will have full discretion on who it does receive the death benefits, but nominating grandchildren can prove a tax efficient strategy, particularly if the funds then bypass their parents or a child of the member who might be a higher or additional rate taxpayer, and they might not need the funds. So we consider the example of Tony, who is age 80. His son John is a high rate taxpayer, but he has 2 children of his own, Josh. As Tony is already over age 75, as and when he did pass away, his any funds that pass to his beneficiaries, when they're withdrawn, they will be taxed at the beneficiary's marginal rate. So if we consider Tony makes a nomination in favour of John, John is a high rate taxpayer. If we assume he is, when he withdraws any of the funds from any of the funds that Tony has left him and designates them to provide an income for him, they will suffer tax at the higher rate. The alternative is that Josh and Beth are nominated, and as you may know, with our form, if you complete our nomination expression of wish form, we have a passage in there to include the widest range of beneficiaries. So Josh and Beth could be included as an eligible benefit recipient. If it was decided that it was appropriate for the funds to be used to designate them to provide a pension, although they would be taxable, Josh and Beth would have their full personal allowances available for each tax year. And although the funds would be held in a junior SIPP, because they would be beneficiary funds, they can be accessed at any time. So that could be used for school fees, it could be used towards, if as and when they're older, towards education costs, as I say, or university costs, or driving lessons, anything like that. That would be accessible at any time and could potentially be tax-free if it was up to their personal allowance for income each year. Okay, so moving away from our 2 junior labelled accounts, I wanted to talk about trusts. So a trust is another way that a gift could obviously be made for a minor child or grandchild with some control remaining over the funds. So this is why sometimes they do look more attractive. Okay, so I did promise you a quick word on parental settlements. I have mentioned it before. So it doesn't apply to junior ISAs or junior SIPPs there, but it does need to be considered in the context of trusts. So where a child has an entitlement to income that's generated from capital gifted by a parent, so for example, a bear trust that we'll talk about in a second, or even actually interest from a children's deposit account, if that capital was saved from the parent's capital, and that income exceeds £100 per annum per child, then the whole amount of income that's generated from that capital gifted by parents will be taxed as if it's the parents. So it's general anti-avoidance rule. It does not apply to grandparents because it's parental settlements. So here, obviously, we've got grandparents who want to make provision and make gifts for children. They're not able to manage the junior ISA or junior SIPP accounts day to day, but they could be involved with trusts, and the parental settlement rules would not apply if they were the settler of that trust. If a parent created a discretionary trust, then the rules actually do sometimes apply in respect of minor children when they receive income, but we'll talk about that in a second. So the first and most simple type of trust that we will look at is bear trust. So no doubt familiar to you all. The simplest form of trust, and the beneficiary is named and fixed at outset and cannot be changed. Okay, so although future children or grandchildren can't be added once this trust is set up, a new bear trust could be established for them. The gift of any capital to this trust at outset is a potentially exempt transfer, or a PET, because we love our acronyms in financial services. And the income and capital belongs to the child. They are the beneficial owner. It can be established, the bear trust, we see this quite often, and I'm sure something you guys have recommended, can be established and run by grandparents as trustees, unlike the junior ISA that must be run and managed by the registered contact alongside the advisor. As I mentioned, yes, the gifts would be pets, so there's no limit as such to what can be paid in as there is with a junior SIPP and a junior ISA, but there are obviously IHT considerations as well. I mentioned the beneficiary has a right or an absolute entitlement to the trust and any income generated from it. The good news is that means that the child's personal allowances are available. So we're talking personal allowance for income tax, capital gains tax. So income and gains could be essentially tax-free if these allowances aren't exceeded. So we're talking about personal allowance, savings rate ban, personal savings allowance, and the dividend allowance. The parental settlement rules will apply. So if a bare trust was set up by a parent and it started to generate income in excess of that £100 per annum per child limit each year, the parents could find that they are actually taxed on that income as if it is their own. So again, this is why we mentioned that it can be established by grandparents looking to make those gifts or those pets. Okay, so in terms of access, if and when this happens, it's age 18 for most of the UK and age 16 for Scotland. Okay, it doesn't automatically convert to a different account like a junior ISA might convert to an adult stocks and shares ISA, and the trust can actually continue once the beneficiary reaches that age of majority. However, what the trustees should do, they should be telling the beneficiary and passing details on, because the beneficiary is of course liable for tax on the income and any capital gains that are generated, and they may need to declare that on their tax returns. So that could be the point that the beneficiary decides they'd like to demand all or some of the capital income, which they are entitled to do, and if they do so, the trustees must execute that wish. There's no disposal for capital gains tax if the trustees appoint the unit trusts or wait out to the beneficiary, perhaps in their own name. The beneficiary is treated as they've owned that property all along, and they will acquire the original base costs of those investments. So that's one thing to be aware of. Again, we're talking about age 18 here. We've seen people have concerns about junior ISAs perhaps, and a new 18-year-old receiving access to what could be a large fund at that age. So if this is a worry for clients and puts them off using JISAs, for instance, then a bare trust is possibly no different in that respect. But again, if the child is aware that there's provision that's been made for them, they're engaged with it somehow, then that might help to alleviate some of the issues of somebody having access to a big pot of funds at age 18. Okay, the second trust I wanted to talk about is a discretionary trust. So these would obviously offer the most flexibility and potential for control. We've seen with the junior SIPP and ISA accounts that they need to be managed by the parent or the person with parental responsibility. Bare trusts are different, but you've got those age 18 concerns again. So if there are concerns about control and access to capital at age 18 and maybe a need for more flexibility, then the discretionary trust is a popular option. So using the name, the trustees have full discretion over the payment of capital and income, and there can be classes of beneficiaries. So unlike our bare trust where that beneficiary has to be named and fixed at outset, here you can make provision for future children and grandchildren by having a wide sort of class or classes of beneficiaries. So all of my grandchildren or all of my children, for instance. So the donor, they can make their wishes clear at outset, and the gift could be made now. Again, which, if it's part of a wider estate planning exercise, particularly for grandparents, that is useful. And the trustees, as I say, have complete discretion over the payment of capital and income. This is particularly useful if funds are needed for a particular purpose, or that's what their sort of desire of making the gift is for, and they might be needed before other accounts could be accessed. So with our junior ISA, for instance, no withdrawals can be made until age 18. But when we're looking at our trust accounts, provided it's for sort of the benefit of the beneficiary, the funds could be used, they could be accessed to pay for school fees, for instance. As there's no absolute entitlement arising at age 18, as I mentioned before, the trustees can wait till they feel that it's appropriate for the beneficiary to have access to some of the money and look after it themselves. Again, if access is a concern. However, kind of all this flexibility does obviously come at a price, and that price is the tax treatment of the account. So a quick word on the kind of 3 aspects of tax that I wanted to cover today. We will just leave it at quite a high level, but again, do let us know if you have any questions as we go along. So gifts into a discretionary trust will be chargeable lifetime transfers. So here we're looking at the tax on the gift. If the value of the gift is over the nil rate band, or the settler has made additional chargeable lifetime transfers, the excess over the nil rate band will face an immediate IHT charge at the lifetime rate of 20%. Transferring existing unit trusts and funds that the settler might hold into the discretionary trust might also trigger a capital gains tax charge, although it is worth investigating whether holdover relief for that may be available. So that's definitely a consideration for grandparents. If the discretionary trust is being established from a gift from parents for minor children, then the holdover relief may not be available. Okay, in terms of within the trust, when the funds are within the trust, so the tax payable by the trustees, income, the dividends are taxed at 38.1%, and all other income at 45% if it's above the standard rate band for trusts of £1,000. It's worth remembering there's also a reduced capital gains tax allowance, and the higher rates of capital gains tax apply here. So we're talking about your 20%. Or your 28% for residential property. As I mentioned, the unit trust or OITs will pay an income either as a dividend or interest, depending on what underlying asset mix is there. If the fund contains less than 60% cash and fixed interest, then all of the income will be treated as dividends. So that will be at the slightly lower rate where it's above the standard rate band. As I mentioned before, care is needed with the parental settlement rules. Where the potential beneficiaries are minor children, although they're discretionary beneficiaries, and there'll be a wide class of them, and they're not necessarily named as and fixed as per a bare trust, when income is paid out to those minor children beneficiaries, the parental settlement rules will kick in. So it's one to be aware of for minor children, and that's why the discretionary trust here is again used more often than not by grandparents or other relatives. Again, there could be periodic and exit charges depending on the value of the trust as well. In terms of tax for the beneficiary, when income is paid to the beneficiary, it's deemed to be trust income. So there's no deemed source as such, regardless of the source of where it came from. It's deemed to be trust income, and therefore it is paid to the beneficiary with a 45% tax credit in lieu of tax that has already been paid. The beneficiary here could reclaim overpaid tax if they are very likely to be a basic rate or non-taxpayer. So the best way to look at this is if we looked at an example. So we're looking at income of £1,000 that has been received by the trust. The trust has had other income, so this isn't included within the standard rate band for trust here. So if we've got income of £1,000, the beneficiary immediately receives £550 with a tax credit for the £450, so that's 45%. As I mentioned, this can be reclaimed if it's been overpaid the tax, so a non-taxpayer could reclaim that £450 and a basic rate taxpayer £250. Just a note here in terms of the trust income and tax credits. The trust itself must have actually paid 45% tax on the income we're talking about to pay out the whole 45% tax credit. So it kind of makes common sense, but it's one thing to be aware of because, as we know from the previous slide, dividends are ordinarily taxable at 38.1%. So there must be enough in the tax pool to enable that tax credit to deem to be paid. As I mentioned before, we just need to be aware of the parental settlement rules with minor children. If the parent's a settler and it's deemed a settler interested trust, the minor child then receives the income, there could be implications for the parents and the tax that is due there. Okay, final word, sort of fits with our discretionary trusts because they are quite similar. So flexible power of appointment trusts. They have the same rules for IHT and capital gains as discretionary trusts. Again, a wide class of beneficiaries is available here only in terms of capital. In terms of income, there must be a named beneficiary. So, as I say, quite similar. The trustees can appoint capital to and can include future children and grandchildren as per discretionary trusts, but there will be a named beneficiary here in terms of who is entitled to all income as it arises. So the main thing here is that the trustees aren't able to accumulate income as they would be with a full discretionary trust. They need to invest in sort of income units and shares, and the income must be paid out to the beneficiary. As I say, it cannot be accumulated. There's sort of two ways they can do this. The first way is that the trustees can account for and pay for income tax at the kind of standard rates, standard band rates of 7.5% for dividends and 20% for income. Because we've got a fixed beneficiary here, they can benefit, the trustees can benefit from the lower rate of income tax on the income that is received. The benefit of doing it this way would be that the trustees can deduct expenses as part of the tax accounting that they're doing. The second way is that the income can actually just be mandated to the beneficiary, and it's then taxed at their own personal rates. So that could be lower or higher depending on what allowances they have available, and is generally the preferred option because there's no accounting that needs to be done by the trustees. The income can literally just be mandated and paid straight out to the beneficiary, but be aware that the trustees then can't deduct their expenses and costs from that as they would be able to with the first options. Finally, just to be aware that those parental settlement rules do apply. So if this flexible trust was created by a parent for their child, for their minor child, when the income is paid out, it cannot be accumulated. The child is entitled to that income, absolutely. Again, the parental settlement rules will catch income above £100. So that's one thing to be aware of. Okay. Just coming on to the final thoughts now and kind of last slide. I just wanted to have a quick word on designated accounts before we round up. So some unit trusts and OICs, they do offer designated accounts, and this allows an investment to be set up in the name of a parent or a grandparent, but earmarked for a particular child or grandchild. However, these accounts usually are just nothing but a naming convention. So I could set up a GIA and designate it as my holiday home fund. Seems a bit far-fetched right now, and there would be no gift because that money still belongs to me, and that money for the designated account for a child or grandchild still belongs to the parent or grandparent. So the funds would still belong to the parents and grandparents, and as a result they would be liable for any income tax and capital gains payable personally on those funds, and there isn't a gift. So as until the child or grandchild actually receives those assets. So let's say when they reached 18, that designated account is then gifted to the child, and at that point it would be a pet. So the clock would start ticking on the pets at a much later date than the accounts that we've talked about today. So it's not considered particularly efficient from an IHT point of view, but again, it's just one option that is available. Okay, so as we've covered today with our kind of four main topics, there's quite a lot of options available there for clients that are looking at making provision for children or grandchildren, and some of them are quite generous now. So you're looking even at your junior ISAs of a £9,000 per annum allowance there. But as ever, we're always looking at a trade-off between tax, access, and kind of how much control is desired by that person making the gift or by perhaps the grandparents that are looking to make provision. So advisors and paraplanners and planners are in the perfect position to kind of help navigate this landscape for clients because it's quite a complicated one, and there's perhaps some unfamiliar sort of implications in terms of the tax on the gifts that are made, and particularly keeping records, especially if we're looking at making gifts out of surplus income. So that brings this webinar to a conclusion today. Thank you for your time, and I hope it was of use. And as I say, if you've got any questions, do let us know, and we'll be in touch with a copy of the slides and your CPD certificate shortly. Thank you.